good day to everyone. This is your tutor for accounting here, Alwin Kwan. So before we start for our class, remember to give my video a like, comment, and share to your friends. Also, remember to hit on the bell button for notifications and latest updates. So, without further ado, let's start for today's lesson. Today, we are going to talk about our accounting period, accruals concept, and our first adjustments. So, this video is mainly about the topic on adjustments. Now, before we move to adjustments topic, let's talk a bit of our accounting cycle. So, earlier on, I've mentioned that we have our accounting cycle over here. So, we've done our document analysis, making entries into our diary books, our journal, our cash book, posting to ledgers, and later on, preparing trial balance for our next procedure. The next procedure will be normally at year end, where we are about to perform closings of accounts and preparation of financial statements. However, there will be adjustments to be made. Either could be matching our current accounting period with all the prepayment and also our accrued payments, prepaid expenses. What are those? I'll tell you in a while. There's many more other than our income and expenses adjustments. We will also cater for depreciation. We'll be also catering for trade receivables adjustments such as provision for doubtful debts as well as our irrecoverable debts. Also, lastly, our disposals. We also have errors as well that we made during our journey from here to here as well. So these are some of our main adjustments that we're going to be discussed in our few parts video. So when we are opening our income statement, you should be able to see sales minus cost of sales plus income and minus expenses. So our income statement as well as our SOFP is based on an accounting period. So what is an accounting period? So accounting period means like a calendar. It's like a calendar, 12 months. Normally, company will work on the accounting period of 12 months. For example, January to December. And if it is a non-January to December period, let's say we have a March, okay, March 2024, the first day we started, it will be ending on 2025, 28th of February. Well, 20th of February doesn't have any 30 or 31 days, yeah? I hope you know that. Okay, we only have 28 days during a normal year and 29 days during a leap year. Okay, so if 1st January 2024, it will end on 31st December 2025, of course. Okay, let me adjust in a bit. 1st January 2024, then it will end on the 31st December 2024 as well. So normally companies will work on the 12 months basis. However, there are some companies who closes their accounts every 3 months, 6 months, 9 months. It can be. But if a very, very, very big, huge organization such as group companies, conglomerates, they will have, yes, still a 12 months accounting period, but they close their accounts quarterly. Every 3 months, they have a financial statements produced, and later on, for the end of the year, they will combine all everything together because it can help work done easier if you do it quarterly, meaning every 3 months, you produce one financial statements. Okay, it's also for the beneficial for the stakeholders out there, the shareholders as well. All right, so accounting period. And we will be having also the concept of accruals, or sometimes known as matching. When we are opening our income statement, okay, we want to produce them, we must follow our accounting period as well as the accruals or matching concept. What does accrual or matching means? It means that the revenue, okay, income during the period, accounting period, okay, so here's the term. During this period, let's say we want to say January to December, much more easier, okay? Revenue during the accounting period is matched against the cost of the period, okay? And they say actual receipts or payment, meaning they are talking about the cash book side. The recording of the money you receive or you pay is not relevant. Of course, when there's a payment received or payment made, you still need to record because it happens. So you need to record it. If not, you can say to people, I don't want the money. Can I? Of course, we want money, right? We get the money lah. Okay. But once we produce our income statement, we cannot rely on our cash book figures. Okay? Cash book can receive money for income, We also can receive money for other income. We pay money for our daily expenses and also for other expenses as well. But we can't use that. We need to base on our accounting period. Meaning to say, whatever payment that must be made between 1st January to 31st December must be recorded, no matter what it happens. Meaning, no matter whether we have paid or not, or we have paid extra, it doesn't matter. We need to show what the must be value in our income statement. For example, if we say our rental is $1,000 per month. Okay, so my income statement must show the real figure. I don't care whether you have not yet paid everything or you paid extra. I just want to know, in our income statement, what must the real figure be reported during the 12 months from January to December in this period? The real figure. So the real figure will be 12,000. So this is the real figure that you must report to people no matter what. The perfect scenario. This is what it means. So the actual figure, the cash book, actual figure paid, meaning the cash book amount that you see, which normally will appear in your trial balance as the amount paid during the period. The actual paid amount is what? 14,000. So meaning to say, you have paid an extra of 2,000. Got it? So this is extra that you pay. Now I'm going to just use rental as the example for the entire time to make things much more easier. Okay, so an extra payment in this case is known as prepayment, a prepaid expense. Okay, and a prepayment will be recorded as a current asset in your SOFP. SOFP will show the truth. Okay, so that will be your debit balance. That would be your prepaid expense. If it's the other way around, if we only pay 10,000, that will mean we have not yet paid 2,000 yet paid. If something is yet to pay, it is called accrued expenses. Okay, and that will be a current liability in our SOFP. Okay, accrued expenses, we will write it over there. Accrued expenses. Okay, so sometimes we put it as other payables. And just now the prepayment, yeah, if it is a prepayment, they will be classified them under other receivables. So this is for the expenses. Okay, now what if I say this rental is something that we need to receive from our tenant? To be received, because rental can be something that we get and also we give. Okay, if let's say we have a shop, okay, that shop is under rental, so we need to pay rental. If the shop has excess of a huge space, we can rent that space for outside vendor who wants to have their vending machine at my place to sell it to my staff or to my customers. And therefore we charge rental spaces. And then we receive the rental income from our tenant. Now again, the same situation, but this is on the income basis part. Okay, the actual amount that we receive, let's say, per month is also the same 1,000. So in our income statement, the real figure should be a 12,000 as well. Okay, for the month of January to December, no matter what. This will be classified under my income. Okay, just now we're talking about rental to pay. That 12,000 should be in my expenses. Okay, so now this 12,000 is our income. If let's say the actual received amount that we had in our cash book, in which we report in our trial balance, is say 9,000, which means we had yet to receive 3,000. So this is called an accrued income, which we record it in our current asset. The heading will be, the title will call accrued income. Okay, because we have to receive, but we not yet receive. If let's say the actual amount we receive from our tenant is 20,000. Whoa, that's a lot, man. Okay, so it will be an excess of 8,000 received. Something that we receive in advance. It's called an accrued, sorry, it's a prepaid. It's a prepaid income. In which case, this is a current liability because we are getting an amount which is related from the future. So that incident haven't happened yet, but we receive something in advance. It's like this. You say to your tenant, hey, my company is having some sort of a financial trouble. So can I get the a few, how many months is this excess? 8 months in advance rental from you, please. It's like you're a bit shy there. You're asking for money. It's like you're borrowing money from people. That's why this is called a prepaid income and will be reported under the current liability section. And you write there a prepaid income. Okay, so this is something you receive in advance. So, in conclusion, what we'll need to do? Okay, here comes the summary. So if let's say for expenses, you have expenses yet to receive, accrued expenses, okay, meaning other payables. You will add your income statement, okay? So, meaning let's say we have an accrued expenses of 400. So our trial balance will have, let's say in this case again, the rental, okay, 12,000. Okay, 4,000 is not yet to be paid. So you need to add this 4,000. Let's see, 4,000, and it will become 5,200 in your income statement. This is the real amount. It's just something like this. You just add up. Okay. And then this 4,000 will be under the SOFP. If it is expenses that you made prepaid, that will be fall under the other receivables in your SOFP. And so let's say you have made a prepayment of say 500. Your trial balance has a figure of let's say 5,000. So this is something related to the future. So your future is next year's January, next year's February. So you need to deduct them off because you only want things that related to this 12 months time. Anything in excess, you do not want them. So you minus them off. So your income statement will show a 4,500 instead. And the 500 here will be shown under the current asset in your SOF. Other payables will be current liability. There you go. Because something to do with the future. So it's like you're giving like a deposit. You can say like that. It's something like a deposit. You pay something in advance. Okay, related to the future. So you don't want. So you need to throw them off away. Now, for income wise, if it is an accrued income, meaning we will write them as accrued income in our SOFP. Okay, accrued income. There will be our current asset. Let's say an accrued income of 5,000, meaning our trial balance might show 1,000, but there's an accrued income of 5,000, so we need to add 5,000, and our income statement will show a 6,000 as the real amount. Meaning to say it's like a January to December. Okay, you only get the income for up to February. Then the balance from March up to December, there's 5,000 of them you haven't received, so you need to receive. You need to add on to your income statement, no matter what. Whether you receive it or not, doesn't matter. You must report as 6,000 in your income statement. And in your current asset, you will record the 5,000 as a current asset as accrued income. If it is for prepaid income, it will be the other way around, current liability. Let's say you have received an income in advance, 3,000. Okay, 3,000. So therefore, your trial balance, let's say, has an income of totaling 9,000. So since this 3,000 is received for future period, you have to deduct them off. So you minus off 3,000 and your income statement will show 6,000. And this 3,000 will be something like a future money received. It's like you're borrowing money from the future. Therefore, it would be fall under prepaid income in your current liability. Income and expense can be anything. Okay, it can be prepaid rental, prepaid commission, accrued rentals, accrued commissions, can be anything. You just put it under the heading. That's all. Okay. So later on, when we have the time, we will see questions about these adjustments for your income and expenses examples. So I see you again in our next coming video for the second part of adjustments. Till then, see you.